Do you ever wonder what it would be like to get investing advice directly from Warren Buffett? As one of history's most legendary investors, worth over $135 billion, Warren has proven his expertise time and time again. Hello and welcome to Wealth. In today's video, we are going to share Warren's best tips for growing your money when investing small sums. Now we know most people don't start out with millions to invest like Warren did. But the good news is you don't need a huge amount of capital to get started and see great returns. Warren explains how he was able to achieve over 50% annual returns early on in the 1950s when he was just beginning his investing journey. By following similar principles today, you can set up your portfolio to significantly grow over time too. So get ready to take notes. Here's Warren's sage wisdom for making the most out of little investing capital. Let's jump right in.
But the biggest mistakes we've made by far, I've made, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting.
Avoid competition by focusing on overlooked opportunities. Alright, Warren's first piece of advice may sound counterintuitive. He recommends avoiding direct competition when possible. Here's what he means by that. Nowadays, the investing industry attracts some of the brightest minds in the world. At prestigious firms and hedge funds, you'll find lots of seasoned professionals working 80-hour weeks trying to find the best opportunities. As Warren notes, the investing world is filled with tens of thousands of incredibly smart, ambitious individuals. It's a hugely competitive space. And while we regular folks may not stand a chance trying to compete head-to-head against these seasoned veterans, here's the good news. We don't need to. Warren realized early on that the most overlooked and undervalued opportunities often lied in smaller, less covered companies that big investors ignored. Rather than fight for scraps from the big players, Warren went fishing where few were casting their lines. As Warren's business partner Charlie Munger likes to say, the key to getting rich is to fish where the fish are. For us, that means seeking out promising investments that the Wall Street sharks haven't found yet. So instead of chasing the hot stocks on CNBC every day, look instead for solid businesses with long runways for growth that are flying under the radar. Use screeners to filter on market caps under $2 billion and low P/E ratios. Sift through those results to find potential hidden gems. While this approach takes patience and work, the payoff can be huge if you uncover promising yet undervalued opportunities early on. Do the digging and research, then invest confidently before the hurt arrives. Focus on smaller, overlooked companies.
We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital because it's always been true. I mean, it was over the years as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than $100 million. But that is not because I'm carrying around in my head the names of 25 companies that we could put 100,000 in. I just don't look at that universe anymore. Sometimes people send me annual reports or get letters from managers, and they say, well, you know, I've got this wonderful thing, and I usually know ahead of time. But I mean, I would first look at the size, and if the size isn't right, and it isn't going to be virtually any time, I don't look any further because there's just no time to be looking at.
Piggybacking off his last point, Warren specifically advises focusing your research on smaller companies when starting out. Here's why. Larger professional investors typically get paid based on a percentage of the assets they manage. So naturally, they're incentivized to gather as much capital under management as possible. but major funds can run into issues investing in smaller companies. As Warren notes, even just 1% of a $10 billion fund still equals $100 million. For a small $500 million market cap company, $100 million constitutes 20% of all outstanding shares. Essentially, the math doesn't work well for larger investors to take meaningful positions in promising small caps. Their buying activity alone ends up pushing the stock prices up very quickly. So big investors often entirely pass over intriguing companies until they reach sufficient size. In contrast, small retail investors face little limitations getting into these situations early. Back when Warren was starting out, he had to pore through piles of dusty financial manuals page by page to uncover these hidden gems. Thanks to modern screeners and online research, the process is far easier today. So don't feel intimidated looking at market caps under $1 billion. Juicy opportunities exist in this range. Be willing to put in the work analyzing financials, growth prospects, and valuations to uncover the real diamonds in the rough. Go all in on your best ideas.
Probably don't advise you to do it at all, maybe, but we would only advise you to do it if you're doing it based on your own conclusions about your own ideas of value and something that you really feel you know enough to buy the whole business. If your funds were sufficient and was being offered to you, you ought to really understand the business. But people do that all the time, incidentally, in private businesses, which have got terrible prospects. I mean, they buy dry cleaning establishments or filling stations or whatever, and they put very high franchises of some kind. They put a very high percentage of their net worth into something that a business is very risky, basically. People put all their money in a farm. You know, it's a business. It's subject to all kinds of business risks.
Here's another counterintuitive piece of advice from Warren that flies against conventional wisdom. When you find a truly wonderful business, don't diversify away the opportunity. Instead, make it a large percentage of your total portfolio. As Warren puts it, truly great investment opportunities are rare. So when the stars align and you find a company with huge upside ahead trading at an incredible discount, you must take decisive action. Rather than limiting high conviction picks to just 5 or 10% of your portfolio as most advisors suggest, Warren advocates making your very best ideas much larger percentages when the certainty is high. He explains most people end up diversifying away their best opportunities and returns in the name of reducing portfolio risk. But when it comes to life-changing upside, you have to be willing to bet bigger earlier on companies with enormous potential ahead. A story from Warren's college days provides the perfect example. Back in 1950, while studying under investing legend Ben Graham, Warren discovered Graham himself owned 50% of a small insurance company named Geico. Sensing opportunity, Warren took a train from New York to Washington, D.C. one Saturday to learn more about this little-known company. After speaking with a senior executive, Warren immediately knew Geico was a golden investment opportunity. He went all in, putting nearly 2/3 of his entire net worth at the time into the small position. Just 1 year later, Warren walked away with a 50% return on his investment and some key investing lessons. The moral of the story? When Warren finds an incredible opportunity, he takes a large position size relative to his overall capital. Rather than diversification, Warren preaches focus, even if it means putting more eggs in fewer baskets. It takes conviction and courage, but the payoff of finding just a handful of big multi-bagger winners early on can set you up for investing success. Think like an owner.
How do I value the business that Berkshire acquires? Well, the first thing I have to decide when somebody calls me is valuing this business within my circle of competence. I don't know how to value Microsoft. I don't know how to value Oracle. I mean, if Larry Ellison calls me or Bill Gates calls me, and they don't. But if any of those, I don't know, or biotech or anything, I wouldn't know how to value it. I just, I'd wish them well and tell them, I think it's worth twice as much as they think it is, but I'm just not in the mood to buy today. I don't know, so it has to be within my circle of competence. My circle of competence is, businesses I can understand. And when I say understand, I don't mean understand how to use a computer or not use a computer in terms of a computer company. I mean understand what the economic characteristics of the business are and what the company's really going to look like in 5 or 10 or 20 years.
Warren Buffett does not view stocks as just pieces of paper to trade in and out of. He sees buying shares of a company as acquiring a stake in a real business. When Warren buys shares of a company, he envisions himself as a part owner. This deeply affects his investment decisions. He chooses companies he would be thrilled to own and run if he had the chance. Rather than obsessing over short-term stock movements, Warren makes choices by evaluating the long-term business fundamentals. He asks himself, how will this enterprise perform over the next 5, 10, or 20 years? Essentially, Warren puts himself in the founder's shoes. He pictures himself building and managing each company from the ground up. Adopting this mindset automatically filters out mediocre business and poor management teams. It draws Warren to proven leaders and strong corporate cultures, the underlying drivers of enduring success. So, as Warren frequently says, risk comes from not knowing what you're doing. Reduce risk by taking an owner's perspective. Know the companies inside and out before investing. Study their products, business models, financials, and leaders until you have 100% confidence. Lastly, as we wrap up here, the core theme across all of Warren Buffett's advice boils down to one key mindset: thinking like an owner. While most investors view shares as abstract assets to trade, Warren sees each stock purchase as acquiring a stake in a real operating business. This distinction affects everything from the research process to portfolio concentration and holding periods. Adopting an owner mentality leads Warren to spend months painstakingly analyzing the economics and leadership of companies before investing a dime. He pictures himself owning and managing each business, asking questions like, would I be excited to run this company day to day? Does the product and service solve a critical consumer need? Do we have disciplined and talented managers in place? Can we reinvest capital at high rates of return over the next 20 years? This workflow naturally filters out mediocre businesses and management teams, directing Warren's capital towards elite enterprises built to endure. The owner mindset also gives Warren conviction to take a more concentrated approach once he has high confidence in a business. If you knew you were buying entire companies at fair prices, would you limit positions to 5% of your portfolio? Or bet bigger on your best ideas? Warren advocates the latter, making your highest certainty investments much larger percentages of your equity capital, rather than over-diversifying away the opportunity. Now, adopting this owner perspective requires work. Those months of research won't do themselves. As a reminder, modern screeners help accelerate the process of filtering through thousands of stocks to identify potential gems. But the payoff can be life-changing. As Warren demonstrated early on, a few massively compounding opportunities uncovered in their infancy can set you up financially for decades. Their future dominance is realized one quarterly earnings report at a time. So while patience and discipline rule the day, remember, wars are won through key strategic battles. We hope Warren's wisdom gives you an ownership framework to seek out and size those iconic investments when the time comes. Well, that's all for today. If you liked this video, we would appreciate if you would like and subscribe to our channel for more videos like this. Thanks for watching.